She is also a CNBC contributor. And Katie, great to see you and have you on a day like this. How are you thinking about, this pullback that we got, that we're getting today, and how deep do you think it might go?
Well, I'm not entirely convinced that this is the start of the reversal down, but it certainly doesn't help the indicators. We have short-term momentum falling off a bit in here. It's starting to impact our short-term gauges to some degree, but not on a widespread basis yet. So we want to give it a couple of days and reevaluate. There are signs of upside exhaustion, very similar to what we saw in mid-August. So your comparison, Mike, to the recent summertime relief rally is very fair. The indicators are set up similarly. The declines, on the back of that, of course, were very severe. So we're sort of mentally preparing for something like that. I do have a sense that perhaps the positive seasonal influences into year end might prevent that until January. But even still, the upside appears to be limited here.
You mentioned, as we've been talking about the similarities to what we saw in the summer, what are the differences aside from just the seasonals? Is anything about the nature of the rally, the internal behavior, the leadership, or anything distinguishing it from what we did see in August with that peak?
Not to any great degree in my work, except for the fact that it's just a more mature bear market cycle at this stage. And we like to see it mature just in terms of the time frame, which we're considering to be year to date. But the market internal measures have not gotten to that place where they're really extreme yet. I think we are going to need to see some kind of VIX reading that's up in maybe the 50 area before we see this bear market cycle culminate. And market breadth looks very similar as well. We saw great breadth expansion for a few weeks, and we have that now here as well, and yet it still is at a lower high versus previous highs. So the breadth measures are still in these downtrending situations. That suggests that we'll see more participation on the next down leg.
And is the pullback that we're seeing in energy, of course, by far the leadership sector of the year, it's continuing today. It's still very modest in the grand scheme of things, but is that something that you think you should be concerned about, or is it an opportunity?
Well, if you think about the energy complex, it really hadn't rallied that or downtrended just like crude oil prices had or like natural gas prices had. So it's somewhat remarkable how well the energy stocks have held up in light of those declines in the commodities. Now that we're seeing natural gas today down something close to 10.5%, again, I find it somewhat remarkable that the reaction just isn't that terrible. And yet natural gas is looking overdone to me on the downside based on the DeMarc indicators, and WTI crude oil has good support in the $70 to $75 per barrel range. So I do think that there's a floor to this weakness in the commodities and also that the energy stocks will be able to resume their longer-term uptrend and also longer-term trend of outperformance. We have in the energy sector something close to a 60% gain year to date, and I think we can trust that next year won't be quite as impressive in terms of relative performance.
Katie, thanks so much. Appreciate you running through it all with us.
Of course, Mike.